One of the things that I do often as a dividend investor is I often mull over or go over the stocks in my portfolio. And to me, it's the best way to be able to gauge what your stocks are doing, how they've been performing, if you need to make some adjustments, if you need to make some changes. And I understand everyone has a different style in investing style, and I understand that everyone has different goals for their investing portfolio. So by no means is this meant to be for everyone, but I do think it's important to go over and discuss a little bit further and more in detail about how certain stocks are dividend traps and how you can actually cost yourself hundreds to thousands of dollars in the long term by just focusing on dividend stocks only that pay out high percentage dividend yields. So I made a dividend video about AGNC. If you all don't know, AGNC is a REIT asset, which stands for real estate trust, real estate investing trust. And AGNC is one of those stocks that pays monthly. So off the top, it pulls investors in because you're getting that consistent monthly income. You're getting that consistent monthly dividend, which means that your compounding is a little bit faster, right? In the long term, does that really change things in a huge way? Not really. I'm talking about the monthly versus quarterly versus annually. However, people do like that consistent monthly income. If you're trying to build up something that you can be able to depend on later on in your retirement, then it would be more beneficial to you, I would think, to have that consistent every month payout, which is why AGNC is one of those stocks that people love to invest in. But here's the thing. I said it before in the video and I said again, AGNC is a dividend yield trap, and I have to let you all know that. Now, I have shares of AGNC right now in one of my portfolios, and I have not sold those shares. I do plan on keeping those shares, and I'm just going to allow the dividends to continue to buy more shares for me. Am I adding more personally? Probably not. But I just don't feel comfortable considering the history of this stock. Now, in that video that I did, someone commented, and I want to share this. I want to share their comments because I think it's important to go over this. And this is not to call this guy out or anything, but I do want to bring him to the front. I do want to bring him to the front and shine a spotlight on what he was saying, because it's important. It's important to understand how to evaluate a stock, even on a basic fundamental level, right? So I'm going to read the comments. We had a little back and forth, me and him, nothing nasty, but we just had a little back and forth. And I'm going to explain to you all how these dividend yield traps get people psychologically in their mind. They think everything is fine when in reality, it's not. All right. So I just want to go over a couple things. We're going to go over AGNC, the stock, and we're going to do a couple comparisons. So he started off and said they stated in their earnings report that they see no reason to change the 12-cent dividend. It was a pretty solid report. They are doing well. Now, in that video, if you haven't watched it, as I said, AGNC is a dividend yield trap. And I said it was a buyer beware stock, meaning newer investors need to be wary and need to be aware that AGNC long-term could cost you a lot of money. And in that video, I pulled up the report from their max chart, meaning over the course and total span from the day that they IPO'd, we have that data. That's the best thing about having history and having the data right at your fingertips. We got to learn and get in the habit of using this. Google is your friend, guys. Google is your friend. We got to get into a habit of using this so that we can pull up the facts and the data let's get out of our emotions. Let's get out of how you feel about it. And let's look at the data, right? So I'm going to go over our back and forth. So he said they stated in the earnings of the report that there's no reason to change the 12% dividend. Mind you, that 12-cent dividend is already down from 16 cent, which was a cut that they had a couple years ago, right? Or a year ago. I'm not sure. Don't quote me on how long ago it was that they cut that dividend. But they've already seen dividend cuts to this stock. More than one, by the way. More than one. So they've already seen multiple cuts to the dividend. The stock was down 50%. So I was telling people, listen, be aware of this stock and its performance. The history tells us that it is not a good stock to invest in. Now, there's a caveat to that, and I'm going to explain what that caveat is after this. So I said down 50% all time is not doing well, and it's not. Down 50% is not doing well. He said COVID is the only reason they are not still offering 16 cents a share. They are doing great. That's what he said. They are doing great. I said, bro, did you read what I said? They're down 50% all time. Meaning, not just during COVID. I'm not talking about the dividend cut here. Their stock price is down 50% all time. That means since before COVID, they've been struggling. That's not doing great. And he responded. He says, damn near every stock is down 50% all time. Now, I want to stop here and focus on this part because I don't know why he would say this. When again, we have the factual data to research, guys, ladies and gentlemen. We have the factual data to research. I don't know why he would say that. That's a crazy statement to say, that every stock is down 50% all time. I don't even think he understands or realizes what that would mean for the stock market. If every single stock, if damn near every stock was down 50%, I don't even understand. I don't think he realizes or understands what that would mean for the stock market and globally across the states anyway. No, globally. I think it will have a global effect. The ramifications of the stock market being down 50% would be, listen, catastrophic. Catastrophic. But let's continue reading. He says, focus on the 5 years for a more realistic analysis, which means you'll need to factor in the economy. The fact that they are holding steady, he said, and are able to maintain their current dividend, which they're not. They've already had 2 cuts, which means you're not able to currently maintain that dividend. But let's keep going. While the economy is gradually improving, is great. They're doing just fine. So I responded again. I said, what are you talking about? Damn near every stock is not down 50% all time. That would be a catastrophic event in the stock market. Prime examples are Realty Income and Main Street Capital. And even if we decided to focus on your 5-year performance and not the sum total of their time in the market, the last 5 years, they're down 47%. That's not just fine. It's concerning. Down 47% in the last 5 years is not holding steady. You don't have to justify your stock purchase to me, and you don't. If you love it, great, but I can't allow you to tell people that a stock that has lost half of its value is just fine without offering any pushback. He responded again. He said, COVID played a major part in that 47%. I told you you would have to factor in the economy, as if I didn't do that already. It would likely still be a 16-cent dividend payment trading at $15 to $18, which means this is a buy zone. The fact that their last earnings were great with all things considered is a major plus, which shows the start of recovery. If you want to short it, be my guest. Nobody is buying the Good Samaritan ploy, but I'd wait until the sell signal again. So I don't have a problem with I have a couple problems with what he said, but I appreciate this back and forth, right? That's what I'm getting at. I like this type of dialogue, right? Because we can't. The best thing about having a social media platform like this is that you get to have the dialogue with people. And I think the dialogue is very important. And not just in investing and not just when you're talking money. I think the dialogue about everything that encompasses our lives, having that dialogue is important, because you don't get anywhere, you don't push forward, you don't accomplish anything without having that dialogue. So I'm glad that he commented, and I'm glad that he sees things a little bit differently as an investor, because that's fine. And, in some sense, he does. Now, I do want to say that he has a point. He has a couple points here that I will say I agree with. I would say that let's pull it up first before we continue. Let's pull up AGNC. I got to pull it up on the stock analysis website. Now, I would say at a price of $9.91, this is a buy zone. I do agree with him that if you were looking to get into AGNC at a price of $9.91, that would be a great buy zone, in my opinion. That would be a great opportunity to buy down or dollar cost average and bring your stock price, your overall price down, right? Your average. Now, but here's the thing. If you're not a newer investor and you've been invested in AGNC since its conception, let's go to the max chart for this. You are hurting right now. You are in pain. If you bought in when it first IPO'd in May of 2008, I don't think that May 19th is accurate. I believe it IPO'd at May 8th or something like that. Don't quote me. Again, Google is your friend. But I believe it doesn't matter. Even here at May 19th, 2008, this is how far back the chart goes. The price was $19.05, people. $19.05. So if you bought in, let's just say that back then you purchased $20,000 worth of AGNC because you believed in their business. Okay? $20,000. You're down 49%. Over 49%. Almost 50%. Let's just say 50. You're down 50% today if you purchased in 2008. Let's go further, because the stock did appreciate, and you saw that it had some incredible highs, honestly. But then, even if you purchased here in 2013 and you said $23, all right, that's not a bad price. I'll buy it at $23. You're still down. Listen, the graph don't. Numbers lie. Women lie. Numbers don't. You can look at the graph all day long. That's not a trending line that you want to see. That is not a trending line if you want to see. Any person that has any experience in investing, this is why it's important to be able to fundamentally look at things even on a basic level and say, hey, this investment might not be the one for me. Because granted, maybe you had accumulated all those dividends for all those years. Cool. But if you had invested $20,000 today, you would be down. Your investment would have been cut down to just $10,000. Just $10,000 worth of your investment. You would have lost half of that value. Now, do you feel good about $10,000 worth? Let's look up and see. Here. Let's do this. IPO'd at 1905. I just want to see what $20,000 worth at $19 a share, $19.05 a share would have gotten you. So you would have had about, let's do that again so I can bring it up. I just want to show you all. So $20,000 worth, right? Divided by $19.05. It equals I don't know, I hope you can see that. It equals about 1,050 shares. We're just going to round up and say 1,050 shares. Okay, so you got 1,050 shares. Let's even, I'm not even going to use the 12 cents. Let's use the 16. Okay, times 16 cents per share. That's how much the dividend is every month. You would have gotten paid $168. $168 a month. Okay. Now, is that $168? And that's without, let's just say that you didn't dividend reinvest, because we just want to use base numbers here. Let's say you didn't reinvest, you didn't auto reinvest. Is $168 worth you losing $10,000 of your investment? You might say yes. If we added up those numbers, here, let's do how many months in a year we got? This is without reinvesting. Let's just say, what did I say? 168. So 168 times 12. So that's $2,000 a year, right? Times, what has it been? 15 years. $30,000. $30,240. Right? You see that? You all can see that. $30,240. Okay, so is having that worth losing $10,000 worth of your principal investment? Some of you might say yes, right? Because hey, 30,000 is more than 10,000, right? But here's the thing. And here's my thing. Here's what I do now. Why make that investment when you could have taken that same amount of money, that $20,000, and invested it into a stock like Main Street Capital? Let's bring up Main Street Capital. Main Street Capital, when you slip over to the max chart, up 185% from its conception. Now you tell me how far your money would have gone. Again, this is another stock that pays, another REIT that pays monthly. Monthly, just like AGNC. However, you're not losing half of your principal investment, right? Right? You've gained 185% of your initial investment if you invested at conception. And look at that. It IPO'd a year just before AGNC. So almost damn near the same amount of history time-wise. It's been around for almost just as long as AGNC. And look at the difference on their max chart. This is why it's important, you all. This is why it's important to research. Even if you make a bad play, it's okay. You can make a bad play. Just learn from that mistake, move on, and get better. Look at the fundamental difference with Main Street Capital max chart and AGNC max chart. I don't know how much more proof you need. All I'm saying is that why buy into a risky asset like AGNC when you have data, factual data, with other assets in the market that you can invest into and be significantly better off performance-wise over the long term? Right? Why? Why do that? Now, I will agree, like I said before, if you were a beginner investor and you were looking to get into AGNC simply for the dividends and you had time on your side, I'm talking for people that are maybe 20 to 30 years of age, maybe even 20 to 35 years of age, and you wanted to just build up something that would give you consistent dividend income with a high dividend yield payout, I understand why you might want to invest in AGNC. Again, it's seen its all-time lows, right? It's near the all-time lows. So you're thinking in your mind, the upside here is potentially major. The upside is potentially massive, especially if AGNC could return to its former glory at the stock price where it was once trading at $35, $33 a share, right? The upside looks amazing. However, do you have enough faith that that stock can rebound to those heights? If so, cool, right? If so, cool. I just want you all to be aware. Just be aware of the traps and the fact that why invest in something that is as risky as AGNC when there are better assets, better stocks, better companies out there who are managing their facilities and companies so much better? Why do that? Why take that risk? I understand everything is a risk in the stock market, but to fundamentally get on here and say that almost every stock is down 50% all time is nuts. That would be a catastrophic event in the REIT industry. Let's look at their max chart. There you have it. Up 663% all time. Realty Income. I just gave you two stocks right there. He said that almost every stock is down 50% all time. I'm sorry, sir. That I can't let you put that information out there and not offer any pushback, like I said in the video. That would be insane. If every stock in the market was down 50%, that would be a catastrophic event. Okay? The world would be in chaos right now. And I just gave you factual proof right here that is just wrong. It's just wrong. It's wrong. Now, if you want to invest in AGNC, do what you want with your money. I'm just trying to provide a little information to give you all a little bit more clarity on your investments. If you could rewind time, knowing what you know now, seeing the data that I just pulled up on the screen, knowing what you know now, if you could rewind time, go back in time, and I gave you, or you had $25,000 to invest into one of these three stocks, would you pick AGNC out of those three to invest into, knowing what you know today? Come on. It's a no-brainer. It's a no-brainer. It's a no-brainer. It's a no-brainer. And that's what I mean. All right? There are better assets out there. You don't have to take that because you don't have to invest in that stock because it's low, right? It has an attractive dividend yield and the price seems low. It's under $10 a share. I understand it's attractive, right? I understand that Realty Income is $50, almost $60 a share. I get it, right? But even if we look at the 5-year history, 5 years is still up 11%. That's what he said. He said, look at the 5, you got to look at the 5 year. Okay, well, let's take the 5 years. 5 years of data, Realty Income is over 11% still up. Now let's look at the 5-year history of AGNC. Five years, down 48%. What are we talking about? What are we talking about? The pandemic and COVID happened in 2020, 2021. This is 2023. That's well over 5 years. Is before the pandemic even happened. This stock was starting to fall. And again, the max chart, it's not good. Year chart, down 20%. Let's look at Main Street Capital. Main Street Capital, last 5 years, up 7%, almost 8%. So even using the 5-year data that he suggested, which I don't suggest, I suggest you take stocks in totality. The history is there for a reason. You got to look beyond the 5 years. But the last 5 years, you could be doing great. Or the last 5 years, you could be doing terrible. Well, if you have all the data there, why not look at it? Why not take it into account? 5 years, the last 5 years, Main Street Capital is up almost 8%. He said everything was down. Damn near. That's what he said. That's factually false. Factually false. So I just want you all to be aware. Just a quick powwow with you all. Be aware when you're looking at these stocks. Learn how to assess these things for yourself. Learn how to look at the data. Learn how to look at the financials. Learn how to look at the financial report. Go over the balance sheet and look at the total liabilities versus the assets. Look at your total debt. Learn what that stuff means. Learn how to look at the cash flow and understand how much cash flow they have versus their debt. And learn how to evaluate a stock based on their financials. So you don't have to be out here guessing whether or not a company is positioned to do well in the future or not. That's it. That's all I'm saying. All right. We're going to disagree on some stuff. It's okay. I welcome it. But that was just a crazy statement that I had to address. And I had to bring it up because I think it was a moment and an opportunity to learn something. All right. Check you all out in the next video.